Hi, I'm Tom Lydon, editor of ETF Trends here in New York at the ETF Boot Camp, and I'm here with Ben Johnson, head of ETF Research at Morningstar. Ben, great seeing you.
Glad to be here, Tom.
So it's been a great day here at the boot camp. One of the biggest subjects has been liquidity, and really with all the volatility we've seen in the market in the last month, a lot of people are pointing fingers at ETFs as being somewhat responsible for everything that's gone on. Can you address that a little bit?
Yeah, well, I mean, you look to that first hour of trading on Monday, August 24th, and we got a really painful reminder of just what that ET and ETF stands for. So you saw some really big names in the ETF universe trade at ridiculous discounts to what we might guess was their actual value.
Yeah.
And it's really dented investors' psychology. I mean, people were sort of conjuring up, memories of the flash crash,
right,
when the whole stock market hit an air pocket and headed south. And it's left people scratching their heads and wondering, is this vehicle in some way impaired? Is there something wrong with ETFs?
Yeah, well, when you put that under the microscope and you see even an S&P 500 ETF that's traded at a 40% loss at a certain period of time, what actually happened?
Well, I mean, what was going on was Monday was teeing up to be a terrible day in the markets in general. I mean, you saw China was down 8% at the close. Futures were limit down. This Rule 48 that no one had ever heard about before was put into place, and now everyone's talking about it. And the market essentially went dark. The prices of Apple, of Citigroup, they came unmoored from anything that really might have seemed reasonable Friday afternoon. And because ETFs are a basket of Apple and Citigroup and all of these different equities, all of which were headed south, all of which were triggering these different circuit breakers, it became very difficult to price ETFs. Market makers took a step back. The chips fall where they may in that situation. And a lot of the people that were picking up the chips, were hitting those trades, weren't even necessarily people. They were these algorithms that in normal market conditions are supplying liquidity to the market. Well, they were getting browbeaten. You saw some stop loss orders get filled. It really just was a chaotic first hour of trading that ultimately resolved itself, corrected in pretty short order.
Right.
And frankly, I've heard more from savvy ETF investors who were frustrated that they couldn't buy at those prices than I've heard from people who got dinged by having sell orders filled at those prices.
Right, so lesson number one is this. If the stock prices are broken that make up the underlying ETFs, then the ETF prices are going to be broken. And then what happened is those APs or market makers just said, hey, we're going to take a step back and we're going to make that spread pretty wide, almost telling the people on the street, don't go near this right now, there's something wrong.
Yeah,
right?
So I mean, people in the know knew to, hey, step away, go have another cup of coffee, come back and everything will be just fine.
Yeah.
The long-term buy and hold investor, this was barely a blip on their radar screen.
Yeah.
Investors who are using certain order types and stop loss orders in particular, which is the same order type that many lived to regret coming out of the flash crash as well, proved to be a remnant of history. They're a relic. Do not use stop loss orders. When you're buying and selling ETFs, use limit orders. So if you name your price, you get your price or better.
Absolutely. So if you hit a stop loss order and you hit that, it doesn't necessarily mean you're going to get out at that price. It means at that point in time, that market or that order goes out as a market order and you're going to be left with whatever the market gives you.
It becomes a market order at exactly the worst time you would want to put a market order out there.
Yeah. So anyway, great lessons. Ben, thanks for taking some time and explaining that. Appreciate it.
I'm glad to be here.
Thanks.